Vietnam started May with a meaningful vote of confidence from one of the world's toughest credit rating agencies. Moody's revised Vietnam's sovereign outlook from stable to positive while affirming its Ba2 rating. The agency cited Vietnam's solid growth fundamentals, strong external buffers, and continued institutional improvements. This is particularly meaningful because Moody's has historically been the most conservative of the three major rating agencies on Vietnam. Together with Vietnam's recent FTSE Russell secondary emerging market upgrade, this means two independent and globally recognized institutions are now sending the same message: Vietnam's long-term investment case is moving in the right direction. At the same time, Vietnam's new leadership continued to maintain an active pace of economic diplomacy. High-level engagements with key regional partners, including India, Thailand, Singapore, and the Philippines, reinforced Vietnam's increasingly outward-looking and pro-growth policy direction. The focus was not only on trade and investment, but also on strategic areas such as AI, semiconductors, defense, critical minerals, regional security, and maritime cooperation. Vietnam's message at the Shangri-La Dialogue was also important, as it reaffirmed the country's consistent foreign policy of promoting peace, cooperation, dialogue, and consultation. In our view, these activities show that Vietnam is trying to deepen economic and strategic partnerships while positioning itself as a balanced and reliable partner in an increasingly fragmented geopolitical environment. On the investment side, FDI disbursements reached $9.8 billion, up 9.6% year over year. Manufacturing remained the dominant sector, accounting for 82.7% of total disbursed capital. This shows that Vietnam's role as a global manufacturing hub continues to deepen. A notable highlight in May was Samsung Electronics' plan to invest $1.5 billion in its first chip testing plant in Vietnam, located in Thanh Nguyen and expected to begin operations in 2027. This project adds to Samsung's existing $23.2 billion cumulative investment in the country and further strengthens Vietnam's position as a regional back-end semiconductor hub. Domestic demand also remained supportive. Retail sales rose 11.2%, while Vietnam welcomed 10.6 million international visitors in the first 5 months, up 14.9% year over year. Visitors from Asia continued to play a key role, accounting for 78% of the total. Supported by a budget surplus of $19 billion, the government also maintained fiscal measures to support local consumption, including the five-fold increase in the tax threshold for rental income from $4,000 to $20,000. Inflation edged up to 5.6%, mainly driven by housing and construction materials, food and foodstuff, and transportation costs. However, the government's nationwide shift from ethanol-free and E5 gasoline to E10 blended gasoline should modestly lower fuel costs and ease price pressures over the coming months. With a strong budget surplus, the government still has room to provide subsidies and keep inflation broadly contained toward year-end. Public investment increased by 11.2% year over year, with infrastructure projects remaining the key driver. Construction activity is clearly visible across Vietnam and is also reflected in higher demand for key materials, with steel and cement consumption rising by 19% and 16% respectively. Manufacturing momentum improved, with May PMI rising to 52.8 from 50.5, supported by higher new orders and purchasing activity. The trade balance recorded a deficit of $13.8 billion, as imports outpaced exports, partly due to higher petroleum imports and rising electronics and semiconductor inputs from South Korea. This likely reflects upstream suppliers increasing shipments ahead of a downstream production ramp-up. As a result, we expect exports to accelerate in the second half and help Vietnam conclude the year with a trade surplus of around $4 billion. Despite the trade deficit, the USD to VN exchange rate has remained broadly flat year to date, supported by a stable US dollar index and more competitive BND deposit rates. In May, the VN index edged up 0.9%, but the headline number did not fully reflect the broader market picture. The gain was mainly driven by a rally in large state-owned enterprises, as investors reacted to renewed expectations of potential state divestment. This came after several companies were classified as not qualified as public companies due to their concentrated shareholder structures. In the same month, the government also met with 23 major state-owned enterprises, where a draft roadmap for divestment and privatization was discussed. In our view, state divestment is likely to gradually take place, especially as the government needs additional capital to finance its ambitious growth agenda. However, this process usually takes time in Vietnam. Therefore, we view the recent rally in state-owned enterprise-related names as largely short-term in nature. For the broader market, sentiment remained cautious despite the resilient macro backdrop. Global uncertainties continue to weigh on investor appetite. Average daily trading value was broadly unchanged from the previous month at around $1 billion USD, while foreign investors continue to reduce exposure with net selling of $746 million USD during the month. In terms of sector performance, financials led the market and accounted for 69% of the VN Index's monthly gain. State-owned commercial banks, particularly Vietcombank and BDV, were the main contributors. Other sectors with large state-owned enterprise-related names also performed well, with energy and utilities gaining 18.1% and 9.7% respectively. On the other hand, industrials was the main laggard, declining 2.3%, mainly dragged down by airline stocks amid concerns over higher jet fuel prices. Information technology also declined by 3.7%, largely due to FPT, as investors remained concerned about the long-term implications of rapid advancements in AI and their potential impact on FPT's software outsourcing business. However, as we have discussed in previous fact sheets, we believe these concerns are overstated. AI is not simply a threat to FPT. It has also been helping the company improve productivity and strengthen its ability to secure new orders. In fact, FPT's total signed international contracts increased by 30% year over year in the first 4 months of 2026. Year to date, the portfolio's net asset value declined by 3.1%, while the reference index, the FTSE Vietnam Index, rose by 2.5%. We remain optimistic on the market, although recent share price performance has diverged from underlying fundamentals. Companies delivering solid earnings growth have barely moved, while the index's gains have remained concentrated in a few heavyweight names. Looking ahead, we expect institutional capital following Vietnam's upcoming inclusion in the FTSE Secondary Emerging Market Index to help unlock fair value in the market. At the same time, upcoming IPOs and potential state divestment should broaden the investment universe and reduce the current dominance of selected heavyweight names. In parallel, market infrastructure upgrades, including the central clearing counterparty mechanism and bilingual disclosure requirements for public companies, remain on track. These developments should further support Vietnam's case for inclusion in the MSCI Emerging Market Watch List, which we expect in June 2027. At current levels, the VN Index, excluding Vingroup-related stocks, is trading at a 2026 forward PE of 10.2 times, well below the regional peer average of around 14 times. This valuation gap reinforces Vietnam's appeal as a compelling long-term growth market.